sign a contract. Similarly, an insolvent once declared by any Indian court of law as insolvent cannot enter into any contract agreement. Therefore, solvency ratio is giving a broad idea of a company under analysis, whether it is really solid, whether it is solvent, whether it is capable of meeting all its outside liabilities at a given point of time. That is measured in terms of 2:1, 1.5:1, 3:1, depending on how much of assets it has accumulated as against the total outside liabilities. The second is liquidity ratios. What do we mean by liquidity ratios? Same story which I mentioned elsewhere about a rich person in America. He was the richest person in America, but at the point of boarding a bus, he did not have the liquidity of a dollar bill. That means $1 note was not obtaining in his purse. He had only credit cards and checkbooks. Therefore, he was illiquid person at that time. See, he was not insolvent. Later on he made good the amount in large measure, looked after the conductor of the bus, treated him largely, all that is story. But that point of time he was not having liquid cash or illiquid. Illiquid means no liquidity. That is a very precarious position for the company. In fact, I was telling you that a company which is not managing the liquidity properly will run the risk of having a run on the company. I am using two words. Run the risk of means it is exposed to the risk of people coming and banging the doors, come on, give me my money, give me my money. Later on the company may have to put a big lock and shutter, leading to the closure of the company. The company may be really solvent. If it sells all its assets, all the borrowers can be comfortably repaid, but the people who demand currently at the doors of the company, if they are not satisfied, they will create a problem for the company, that is run on the company. Now, liquidity ratio is one ratio which is giving the analyst, a financial manager, a third party who is looking at the financial position of a company as to the company's ability to meet the current pressures or the current liabilities. How quickly it can settle the bills, how quickly it can pay the payables, how quickly it can do the creditors settlement quickly. See, this is liquidity ratio. How are you going to find liquidity ratio? Just apply your imagination. Liability, current liability is always settled with current assets. What are current liabilities? Bills payable, sundry creditors, isn't it? Income tax payable, wage payable, bills payable, all that. Now, in the case of current assets, cash, bank balance, stock, inventory, bills receivable, sundry debtors, all those things. Now, all these amounts put together should be comfortably more than the current liability. Current liability, as I said, is amount to be paid. Current asset is amount to be received, which are currently in nature or in operation or in rotation. The rotating money receivable, the rotating money payable, they are compared. If the rotating money payable is much more than the rotating money that is receivable, the company is not in a liquid position. It has to borrow temporary overdrafts from the commercial banks. On the contrary, if it has got adequate and enough resource in the form of stock, receivables, cash and bank balance. If stock is there, it can be sold and converted into cash, and that could be used for settling a bill, isn't it? Similarly, if there is bank balance, it can be drawn and paid. Say, These are all liquid funds, are easily convertible.